If you have been searching for a ranked list of term insurance plans in India, expecting one name at the top, here is the honest truth. There is no universal answer because the question is personal. The plan that fits you depends on your age, your income, your health, and the risks your life actually carries. So instead of a ranking, this video does something more useful. It walks through exactly what a 30-year-old salaried professional should check. 4 numbers, all of them public, all of them about you. For a 30-year-old salaried non-smoker in India, the right term insurance plan is determined by 4 numbers. A claim settlement ratio above 97%, an insurer solvency ratio above 1.5, a premium that's competitive for your specific health profile, and riders that match your actual risk. The claim settlement ratio is the percentage of death claims an insurer paid out of all claims received in a year, published annually by IRDAI for every life insurer. What matters here is why the threshold is 97 and why that numbers matter more at age 30 than at any other age. Think about the timeline. A policy you buy at 30 might be called on at 60s or later. You are not evaluating how an insurer behaved last year. You are betting on how it behaves decades from now. 97% and above, held consistently across recent years, tells you that your insurer is paying claims, but a single spike above 97 tells you almost nothing. Pull the last 3 years from IRDAI's annual report and look for the flat, steady line. ABSLI's individual or retail claim settlement ratio for the last 3 financial years, as per annual audited figures submitted to IRDAI, are FY 2025 to 2026, 98.86%, FY 2024 to 2025, 98.74%, FY 2023 to 2024, 98.49%. That consistency over multiple years suggests a stable claims experience rather than a one-off spike in performance. The second number answers a question most 30-year-olds never think to ask. Will this company still be financially sound when my family actually needs it? The solvency ratio is the insurer's financial cushion, its capacity to honor every payout it has promised. And IRDAI requires every life insurer in India to maintain a minimum of 1.5. For you, the age does the framing again. A term plan bought at 30 can run to your 60s. The insurer does not just need to pay claims this year, it needs to outlive your entire working life in good financial health. The regulatory minimum of 1.5 is your floor, and an insurer holding comfortably above it year after year is signaling exactly the kind of long-term stability a 30-year-old contract deserves. This figure is public too in the insurer's disclosures and an IRDAI's annual report, usually on the same page you just checked for claims. Number 3 is premium. And at age 30, you hold an advantage worth understanding. Premiums are priced on age and health at purchase and then locked for the term. So the quote you get now is the one you keep for decades. But competitive compared to what? Not your colleague's premium, not a generic advertised figure. Premium is priced on your age, your health declaration, your medical results, your smoking status, and your occupation. So the only meaningful comparison is between quotes for your exact profile. Same cover amount, same policy term, same honest declaration across 2 or 3 insurers. Here is how to run that check in practice. Fix your inputs first. Say rupees 1 crore of cover, a term running to age 60, and your declaration exactly as you would submit it. Then request quotes without changing a single input between insurers. Keep the rider selections identical too, because one added rider can quietly explain an entire price gap. 10 minutes of discipline here is what makes the comparison real. If the quotes cluster together, your price is fair. If one is far lower, read what is different, the cover, the term, or the assumptions before you celebrate. A quote is only a bargain if it is for the same thing. The fourth number is really a match. Riders against your actual risk stage. Riders are add-ons to the base policy, and at 30, they deserve your attention. The critical illness rider pays a lump sum on diagnosis of a listed serious illness, and the reason it belongs on a 30-year-old's checklist is timing. You lock it in while you are healthy and it is at its cheapest, because adding this kind of protection later, after diagnosis, is far harder. The accidental death benefit rider pays extra over the base cover if a death is due to an accident, relevant if you commute daily or travel often for work. The principle is match, not maximize. A rider that covers a risk you genuinely carry is protection. A rider stacked on because the list looked thorough is just premium. Picture two 30-year-olds. One rides a two-wheeler through city traffic every day, the other works from home. The accidental death rider is a sensible match for the first and mostly cost for the second. Same age, same salary, different answer. Check the terms of each rider. What it covers, what it excludes, what it adds to your cost against your own life, and take only what fits it. Now you have the four numbers, so use them, including on us. ABSLI's term insurance plans like ABSLI Salaried Term Plan and ABSLI Super Term Plan can be evaluated on all four. Its claim settlement ratio and solvency ratio are in its public disclosures and IRDAI's annual report. And rider options with your premium codes for your profile are on the ABSLI website linked below. At the start of this video, I said there is no ranked list with one name on the top. So let me leave you with direct answers to the three questions that this decision actually hinges on. Is a higher claim settlement ratio always better when picking a term plan? Generally, yes, but check the 3-year trend rather than 1 year's number, since claim settlement ratios can fluctuate year to year based on claim volume and complexity. Does a 30-year-old need different riders than a 40-year-old? Often yes. A 30-year-old typically has fewer health risks but may want to lock in critical illness cover early while premiums are lower, while a 40-year-old may prioritize riders covering lifestyle-related conditions that become more statistically relevant with age. Does a higher premium always mean better coverage? No. Premium reflects the insurer's risk pricing and distribution costs, not necessarily product quality. A higher premium does not guarantee a better claim settlement ratio or stronger solvency position. Four numbers: a claim settlement ratio above 97% held steady, a solvency ratio above 1.5, a premium quoted for your exact profile, and riders matched to your real risks. That is how to find the right term insurance plan for you, and every one of those numbers is either public or personal. None of them belongs to a ranking. If this helped, like the video, subscribe, and check the description for ABSLI's term plans and disclosures. Run your phone numbers this week while 30 is still working in your favor.